All right, hey guys, welcome to week 7 for FP&A practicality. So just to start off with, when examining the financial planning and analysis technology in the real world, we can really notice that it's a bridge between technology and finance. And within that, we can see that analytics is slowly playing a greater role in the expansion and automation of the industry. And most financial statements are actually formatted in a really similar way. They have a set of standards. For example, we have the GAAP standards, the generally accepted accounting principles in the US, or the IFRS, the International Financial Reporting Standards in other countries. So these standards have essentially allowed for artificial intelligence to automate financial statement analysis using machine learning. So essentially, the artificial intelligence can read through the financial statements and do a very baseline level analysis and conduct this. And then the AI can also be used to identify sales and cost drivers. And then also which decisions are contributing to the optimal level. So governance protocols and stuff like that. So essentially these neural networks are enhancing the day-to-day operations for FP&A. And this is then allowing team members to do a deeper level analysis, focusing more on analytics or decision-based tracking. So basically in summary, AI is doing a very base level analysis. It's looking more just doing a basic level. And then this allows analysts to actually go to do a much deeper level. So when looking at the types of technologies used, we notice that Excel is very commonly used. And this is predominantly due to it being a legacy tool. So companies have been using Excel for so long that they're reluctant to move past it. And then we can also notice that data visualization is becoming increasingly popular in the operations of FP&A. So Tableau and Alteryx are often used in conjunction with each other. So Alteryx makes sense of the data. It essentially cleans it up and combines it. And then Tableau is used to present it in a more visually interactive or appealing way. We then also have Power BI, which is used by Microsoft. And it's turning unrelated sets of data or sources of data into a more visually interactive or immersive insight. And this is also compatible with Excel. And then finally, we have SAP Analytics, which combines business intelligence, augmented and predictive analytics. And then also it puts planning capabilities all in a cloud-based environment. And then within these technologies, we also have more computer science heavy knowledge skill set coming in. So programming languages such as Python, C, C#, C++, Java, JavaScript are being used to automate repetitive processes. And then we also have SQL to manage databases, look at data and examine those further. And we can use those through SQL Server, MySQL, Workbench, MS Access, or Toad. So when really looking into an example of financial planning analysis in action, we can first examine capital budgeting, which is essentially the plans for a large scale investment opportunity or business activity that are then reflected in the financial statement of a company. So an example of this could be a PP&E acquisition or replacement, and this is predominantly equipment. PP&E is plant, property, and equipment. We then have M&A or mergers and acquisitions, or even just an introduction of new products or services by a firm into its home base, like Apple trying to introduce a new phone or something like that. And then we also have more examples, obviously. And then when examining the sort of risk analysis types that are there, we have simulations. So this is essentially assigning a probability to a distribution and then trying to calculate the expected value for each scenario, or sensitivity analysis, which is changing one variable at a time to see its impact on other values or on the overall picture. So changing the weighted average cost of capital, or the debt to equity ratio, or even just future cash flows. And then finally, we have scenario analysis, which is changing more than one variable to then come up with multiple different scenarios. So for example, a buy versus build scenario. Should we build our own product, or should we sell the third party manufacturing to someone else and have them build it for us? Should we for mergers and acquisitions, or should we have a low interest rate or a high interest rate, kind of competing those for those environments? And then low output versus high output, how would it change if we have a low output today, or how do it change if we have high output? And then Sean, would you want to explain this part?
Yeah, so this is our last slide pretty much. Essentially, budget analysis has to do with how you can budget for your inflows of cash and your outflows of cash through financing and operating. in order to help form your income statement and your balance sheet. Now, when we talk about operating, we talk about all the line items in SG&A and COGS. So anything above the operating profit line or EBIT, and anything below EBIT, which is essentially just interest and debt. In this case, we're only talking about interest when we care about financial budget, and equity if you're paying out dividends. That's what we care about for financial. Operating is COGS plus SG&A. Anything above EBIT is operating, anything below EBIT is financial. And you use those two budgets to help form the income statement and the balance sheet. And how that's shown, for example, in the operating budget, if you can budget your cash inflows and how much you're budgeting for revenues, that can directly link to your income statement revenues, as well as your accounts receivable for balance sheets. Because if you look back to one of our previous lectures I mentioned, or in multiple previous lectures, I mentioned that accounts receivable is driven by revenues. The more revenues you have, the more likely you will have greater accounts receivables, because not everyone's going to pay on time. And the more the people that buy from you as customers, the higher the chance that you get more people not paying on time. So you have a higher accounts receivable, more people buying on credit, or more people who are going to pay you on a later date. That's why that number goes higher as revenues go higher. Purchases. So purchases and production, these are the things that drive cost of goods sold, or COGS. So the higher the purchases budget is budgeted to be, the higher the cost of goods sold will be, or at least anticipated. Same thing with inventory. Inventory is driven by cost of goods sold. The more the cost of goods sold, the more the inventory, the more the cost of goods sold, essentially. As well as the other way around. Sorry, COGS drives inventory. And accounts payable, pretty much the same thing. The more cost of goods sold and purchases you have, the higher the accounts payable you'll have, because you're buying more things from suppliers. Therefore, you will most likely take a longer period of time to pay off more of those things that you're buying. So if you buy like $1 million worth of product as opposed to $100,000 worth of product, your accounts payable will be higher for when you purchase $1 million worth of product. Even if the percentages are the same, the gross amount will be very different because you're buying more in the $1 million case. Hence, the accounts payable will go up as your purchases go up, and so will your cost of goods sold. And then, you have other operating expenses, mainly marketing, any other ones. Insurance is another one, rent, wages. So you have to budget for these things in the operating budget, and they directly relate to your income statement. So those things don't go in your balance sheet because those are fixed costs, and those have to be taken into account in each accounting period. Whereas the balance sheet is kind of what hasn't been accounted for yet. That's not a periodic line item. Balance sheets are over time, and they're a snapshot. Whereas income statement only includes the things that are within one financial period. And then finally, interest expense is the only thing in the income statement that is under the operating profit line or under EBIT. Therefore, it falls into the financial budget, not the operating budget. Operating is above EBIT, financial is below EBIT. And when I say below EBIT, like I said before, I'm really only talking about interest expense. So how much debt does our company have? The higher the debt amount that our company has, whether it be short-term or long-term debt financing, the more the interest. Because if you're paying interest of 5% on $1 million worth of debt, you're going to pay more than if you're paying 5% interest on $100,000 worth of debt. So if you have $1 million worth of debt and you're paying 5% interest every year, that's $50,000 worth of debt. Now, if you're doing the same thing for $100,000, that's only $5,000 in interest expense. So interest expense directly goes up as you take on more debt, which makes sense. You're paying more interest as your debt amount goes up. And in terms of balance sheet, the amount of cash that you have left over from your net income, your retained earnings, your shareholders' equity, and of course, debt we mentioned before. Fixed assets is not the same as SG&A. That can be a little confusing to think about, but fixed assets are permanent fixed assets that are used and capitalized. They're needed to run the business. So a fixed asset can be plant, property, and equipment. That's something that can't be put in the income statement because you're not using that only within one financial period. You're using that over time, and therefore it's depreciated. So those are the things that can count as fixed assets. That's very different from marketing expenses, because for marketing, you are, marketing your products within a financial period. You're only doing that anticipating that you'll be marketing for the sales that you get within one fiscal year. Not the same as equipment or plant and property, because you're going to need that for a long period of time. So those long-term assets are fixed assets. Shareholders' equity, that's retained earnings plus whatever equity the investors put into the company, including yourself as the business owner, if you are in this case. The cash is just whatever is left at hand in terms of cash. Retained earnings is basically net income minus dividends, which is whatever money you have left after paying your shareholders dividends. You put the rest back into your balance sheet, and that goes into shareholders' equity. And then financing is just debt. And financing directly correlates with interest expense as well, as we said. So a lot going on here, but I think it illustrates how it's very important to make both operating and financial budgets to directly correlate with your income and balance sheets. Because although income and balance sheets are the only two statements you really need in order to report it to the IRS and to report it in your 10K, in addition to the statement of cash flows later on, when you're calculating your discounted cash flows, budgets are extremely necessary internally. So you can think of budgets as internal, whereas your income statement, balance sheet, and also statement of cash flows, which isn't on here, as external. That's pretty much it on my end. So I think we're set.
Yeah, I think that's the rest. Okay.
I'm going to stop recording for now.